I co-founded a shop back in 1984 called Riverside Capital in Southern Florida. And in those days, it was called Fallen Angels. It wasn't even called High Yield at that point. We were buying Rust Belt, Midwestern manufacturing companies. We were buying nuclear utilities, and we were buying standard, longer-dated paper. As you recall, in the early 80s, interest rates spiked. Our portfolio got crushed. Luckily, with the blessing of the client, we decided to lower the duration of the portfolio to make it less volatile due to interest rate spikes. So we gradually morphed the portfolio into a shorter duration book by reinvesting when a bond came due into a shorter duration bond. So by 1987, we had done that. So we had a 2-year duration book, which is the same strategy and duration that we do today here at Concise. And we built the firm with institutional clients here in Europe, Siemens or Hearst. In the United States, we had a number of well-known institutions, Vanderbilt, UVA. We had Gordon Getty Jr. of the World Bank, McKinsey, the consulting firm, Jerome Kohlberg of KKR. And we built the firm to over $400 million. I sold my 50% interest in 97, and I reinvested that capital into a telecom company in Miami, which I took over, became president, and did a reverse merger with a company in Southern California. So I moved out to Newport Beach, California, to run the company. It's a pink sheet, small cap company, and eventually we sold that in 2003 to Portland General Electric, our largest client. And I point all that out that I'm probably one of the few portfolio managers that you've seen that actually run a company, made payroll, signed off on 10Ks, dealt with all the issues that you can imagine running a public company. We decided in 2004 to get the band back together. I formed Concise with my partner, Tom Krasner, who used to work with me at Riverside, and we founded Concise. We founded it with $5 million from a client in Geneva, and today we're a $500 million shop, and that's the background.
And so one of the key elements is obviously that both Tom and Glenn, as co-portfolio managers, do have that hands-on operating experience, which helps us understand how management are going to respond to different environments, how they're going to treat bondholders and certain capital structures. So perhaps if we move forward a little bit to talk about the strategy in some more depth. So our focus area within high yield is really, I guess, superficially in the duration range of between, say, 0 to 4 years maturity and an issue sizes of $500 million and under. A large proportion, perhaps the majority of the high yield market is really dominated by very large players, ETFs and mutual funds, which tend to have very rules-driven models and approaches to the way they invest capital into the marketplace. So they will be reliant on credit ratings, and credit rating agencies will have restrictions on how much capital they can have in any different credit rating and the position sizes across their portfolio. They tend to be, in our opinion, overly diversified with many hundreds of positions on an underlying basis, whereas, for example, once we apply that short duration filter into our portfolio and the small issue size of 500 million and under, that creates a universe of around 700 bonds. And from those 700 bonds, we're selecting the top 40 to 45 in our portfolio at any one point in time, of which around 10 comprise 40% of the portfolio, the top 10 largest positions. So you're talking about a core position size in the region of 4 to 5% and an initial position size of around 1%.
So it's a value-driven strategy. Two hallmarks, again, is duration of 2 or sometimes under, 1.8. That reduces interest rate risk and volatility, and we would argue it also reduces credit risk. We marry that with what we call underfollowed or underloved issues, and simply put, outstanding issue sizes that Andrew has mentioned, less than 500 million. But to be clear, the high yield market is dominated by the new issue market. Again, we're in seasoned issues, and it's dominated by larger players, multi-billion-dollar type mutual funds or ETFs that are size-bound to buy much larger issue sizes. So by dipping down into the market that we're involved in these seasoned secondary issues, we're getting quite a bit more value. This is not a strategy where there's a lot of sell-side coverage. We're dealing primarily with secondary shops, and we're all about fundamental, bottoms-up research. Our strategy is very research-driven. We take maybe 3 to 4 weeks, if not a month, to build our models, to develop our write-ups, to work it through our investment committee, to get it to the point where we're ready to put it on the buy list after it's been voted on by the investment committee. And that whole process is really important because if you look at what we do, the short duration book, what's really interesting is that portfolio, 50% of the book turns into cash naturally every year, and it's done that over a many-year period, if you look at our track record. And so what happens really in the book is the treasurers don't wait to the last moment to mature the next bullet issue doing their capital structure. They do typically take it out 6 to 9 months early, or they're trying to avoid being dinged by the auditors to have a going concern or an issue that's going current. And so they take these bonds out early, which means that 1 to 2 bonds per month turn into cash, again, naturally. No transaction costs. And it's predictable enough that we have to feed that cash or that reinvestment theme through our research process, which I just enunciated on. And so
we can drill through that process a little bit now as well.
Sure. Well, again, with 700 names in our universe, we boil that down to roughly about 200 bonds that kind of hit the center of the fairway. Now, what are we looking for? We're looking for something that's senior secured. If you look at our book, we don't buy sub-debt. We're essentially the bank. And what that does for us, obviously, is put us in a position where our leverage is lower. So the average net leverage in our book is 2 to 4 times, which again is substantially less than what you're seeing in the new issue market. Also, because these are seasoned names, they are free cash flowing. They are deleveraging. So this is the last couple years of the life of this bond. The company is in there, in many cases, in the market, trying to buy these bonds under par if they can, and we have to be in the market competing against them, if not being a little bit ahead of the curve, because quite frankly, they're free cash flowing. And so at the end of the day, you're looking at a book that rarely has to go into the refinancing market. These individual companies are able to then to tap the banking and go into a secured banking debt. So these are not serial refinancers.
One of the key things we're looking for when trying to identify a bond that's suitable for the portfolio is a company whose financials will improve during the holding period in our portfolio. So when you look back historically, what you see is less than 10% of the names in our portfolio over the last 14 years have been names that we've reinvested in the portfolio. That's generally because, as Glenn mentioned, the exit might be outside the high yield market. They're not constant reissuers, refinanciers. So one of the, I think, misconceptions often of the high yield market is that there's a bunch of companies out there with a bloated debt load that they're constantly having to roll over. So that's not the case in our portfolio at all. As these maturities are reached, we are not then buying bonds in the same names. We're constantly looking and reinvesting that capital in new opportunities that throw themselves up through our bottoms-up screening process.
So needless to say, our research process is rigorous. We talk to the management extensively. We work really hard to do all of the bottom-up work on these credits. For example, if there's less than 35 bondholders, you don't necessarily have to file your financials on Edgar. So we have to go in, buy a bond, call the company, get access to some kind of data site, and do a research. So what I'm trying to say is, if you're a larger player and you're not going to go through all that work to do all the research, we're only buying, let's say, a 15, maybe 20 million bond position ultimately in our portfolio. It's just there's just less competition on the buy side for that kind of paper.
And the result is obviously that we get overcompensated for the risk we're taking in the portfolio, which of course is what we're all trying to achieve from our investments. So perhaps if I flip back a slide here, we can talk a little bit about the natural liquidity of the portfolio again, just to emphasize that. So on average, around 50% of the portfolio, as you can see there, is naturally turning to cash every year. So 4 or 5% of the portfolio every month, either through calls or maturities. And although we say that we have a stated duration in the portfolio of around 2 years, the reality is the average holding period is around 15 months because those companies are calling the bonds early or those bonds are otherwise getting taken out. I will just indicate there that the last 12 months, you can see the natural liquidity of the portfolio has been quite a lot lower than previous years. That's because actually we were taking profits a lot on positions last year, and so we actually sold positions prior to maturity, which don't make an impact into this chart either. This is purely the natural liquidity of the portfolio where bonds are being matured or called. So you can add on top of those numbers another 25% of positions that were sold where we're taking profits. So what we're trying to do is harvest that hidden value for as long as possible in our portfolio. But when a situation occurs that value is recognized and the yield might trade down from, say, double digits today to low single digits, we will then sell that position and reinvest that capital at a higher rate.
I mean, what you see in the portfolio as the portfolio and individual bonds get more seasoned is this pulled to par. It's the catalyst that creates the value. And if a bond does stay in the portfolio, let's say in the last 3 to 6 months of its life, there's a whole set of buyers that do come into the market, yield to call type buyers. They bids the paper down to 3 or 4% yields. We're happy to harvest that bond and then reinvest it, obviously. And in today's market, for example, we're getting low double-digit type yields in the book. 10, 11, 12% is the type of yields where we're reinvesting today. And again, if you think of Concise, you really need to think of us as a reinvestment vehicle. That's exactly what we do. We harvest that cash at par every month and then reinvest it at whatever the market will bear, and in this scenario, low double-digit yields.
And what the result has been for the portfolio, we're showing you the longer-term offshore track record here. You can see that we have a very low overlap in the bottom right-hand side corner there with the ETFs, the benchmark indices, so around 8%. And if I show you the UCITS as well, you'll see that benchmark again. The overlap is at 8% in line as well. So what you find is you have a low correlation product or lower correlated product that's generating better than benchmark returns with substantially lower risk.
And that's what we do. It's a low vol product. It's a non-ETF product. You can't get this somewhere else. And what we believe it's a niche that's it creates not just value but opportunity, particularly in a market that we're experiencing today. That it's hard to find alternatives that have as many attractive points as we do.
So there are multiple layers of downside protection in the portfolio. As a result, you can see here that returns in March of 2020 are, although negative, substantially lower than the drawdowns experienced by the benchmark, which was around 15% in that month. And again, if I get the slide correct, same for the UCITS. Drawdowns were similar as well in that time frame. And of course, we were positive in 2022 when the market obviously had a very tough time. So I'm going to forward here to a slide showing some key features and characteristics of the portfolio. So one of the things you notice up here is the S&P credit rating in the top right-hand corner pie chart there. We've put that together to demonstrate what the ratings would be if you were looking at the S&P credit rating, although we do not obviously rely on those credit ratings at all. A lot of our competitors require those ratings for their portfolios. We do not, which is why you can see that a third of the portfolio is in fact non-rated. So there may be many reasons why a bond could be non-rated, but in fact we're able to do that credit work, that fundamentals, bottoms-up analysis to get comfortable with the credit risk that we're taking in the portfolio. And again, the bottom right-hand side pie chart, you can see that the seniority is senior or senior secured, no subordinated paper, no preferred securities. We are not reaching down the credit spectrum to achieve the yields that we have in our portfolio. And that non-rated portion of the portfolio, we would say, replicates the rated portion of our book. So we would say that on average, the fund is around single B or single B minus across the entire credit quality of the portfolio, including the non-rated portion. But the non-rated portion allows us to generate, again, excess yields, even in excess of what we're finding in the underfollowed rated portion of the portfolio, probably an extra 1 to 2% on top of what we see from the rated side of the portfolio. So today, the current yield of the portfolio is 11% yield to worst, which we think is great in this environment for the risk in the portfolio. If we just flip across a few more slides here, we'll touch on our hedging. So
we use the Russell 2000. Actually, we use the ETF, the IWM. We're piggybacking on research that was done back in the 90s with Marty Friedson. He was head of Merrill Lynch's high yield technical group, and he figured out the correlation between high yield and the Russell. And you know, it makes intuitive sense. You know, it's a small cap type equity ETF, and you know, we have roughly a small cap type strategy. But we've done our own back testing, more importantly, and over a long period of time, we figured out that in down markets, the correlation is over 70%. And as it applies to our portfolio, the relative volatility is roughly 3 to 1. So if we buy short 5 cents of the Russell, the effective hedge in our portfolio is 15%. So we don't need that much in order to have a reasonable hedge. We do vary the hedge, and we've done well this year with having roughly a 10 to 15% hedge in the book. We can take the hedge off if we choose. We were not hedged in the latter part of last year, and now we may take the hedge off at one point this year. But it's a good, inexpensive, low cost, low drag type hedge as compared to some of the alternatives that applies very well to our book to reduce equity tail risk and volatility.
So what we're really doing with the hedge, as Glenn mentioned, is reducing equity risk, tail risk and volatility, and not using it necessarily as an alpha generator, but helping us to protect the portfolio at times of market stress. We don't short individual name credits because it's a short duration book with a catalyst. We rely on the bottoms up fundamental work that we're doing to protect the portfolio from that perspective. And also it's very difficult to find a credit which is not already trading at a distressed level and about to go bankrupt within the short duration framework that we have in our portfolio. So other options could include CDS. CDS is fairly expensive. You have to roll that frequently. At the same time, unfortunately, it doesn't work in periods of crisis like March 2020 that we saw, or 2008. You tend to end up losing on both your portfolio and on your hedge. And again, options are something which we could do, but you have to be very certain about the timing of when you want to protect that portion of your portfolio. So we find that given the 2 to 3 times relative volatility of the Russell versus the portfolio, again, very cost effective, simple, easy to understand, and we can put it into the portfolio and take it off very, very quickly. So to give you some sort of tangible examples of how we might use that hedge in practice, coming into 2022, the high yield market was yielding 4 to 4.5%. Our portfolio was yielding around 6.5%. We had that cash coming back from those maturity dates in December, we were looking to reinvest that into the bench of names that we had in our portfolio. And each of the names that gets approved by the investment committee has a target yield attached to it. So we'll say we will invest in this name at a yield of X or better. And we were finding that the names on our bench we wanted to allocate capital to were in fact below our target yields. So in that circumstance, what we do is we build up some cash. We're not forced to reinvest at the market rate. We'll reinvest that capital when we find attractive yields, and we added the hedge into the portfolio in January of 2022. At the end of the first quarter, the market sold off. Suddenly our target yields are being achieved in our portfolio. We're reinvesting that cash, deploying that into the market, being a capital provider and monetizing the hedge. And then we're actually running unhedged for the remainder of the year from April through to December 2022 because we were happy with the bottoms-up fundamentals of our portfolio and we felt that the market was functioning well. Coming into January, you again found a very strong month at the beginning of the year. Equity markets were up, credit markets were up, and we became concerned that the market was getting ahead of itself. We added the hedge back into the portfolio and we're monetizing it again in the periods of volatility that we've seen over recent weeks. I'll flip through here a couple more slides just to discuss the team. So you've got there Tom and Glenn as portfolio managers. They sit on the investment committee with the 3 analysts underneath them as well. Each of these analysts is seasoned analysts, have been with us for a long time. In fact, Robert is the one who's joined most recently in the last couple of years. James and Andriana have both been with the team for over 5 years. And it's a very collegiate process. The investment committee, every name that is put forward is championed by one of the analysts, including Tom and Glenn. And then Tom and Glenn each have a veto on any individual name coming into the portfolio. So it has to be a consensus-driven opinion to approve a name in the portfolio. And it might be that if we turn a name down, we'll then go and do further research until that research is completed to the satisfaction of the investment committee, and at a later date, we approve that name for investment into the portfolio.
And when we buy a name, when we're comfortable with it and it reaches our yield criteria, which is, again, a critical part of the value we add in terms of sourcing this paper, but we'll typically wade into a name, buy 1%, maybe 2%, watch it over a quarter or two, and may build the position, maybe not. But if we do, we'll build it into a 3 or 4% position, and that's typically, our sizing of the book. Roughly 40, 45 names in the book at any one time.
I'm conscious that you guys don't have presentations in front of you other than what we're showing on the screen, so I'm just going to put the track record up there to sit for a little while. But you can see essentially we're returning 50% more than the benchmark over the time frame of the UCITS with substantially lower volatility. So from a risk-reward perspective, we perform very, very well, and we're happy to share those further detailed metrics with you if you'd like to reach out for more information. So thank you for joining us today, and look forward to continuing the conversation with each of you in due course.
Thank you.